We're coming into the end of the year holidays. You know what that means? Stock market predictions. Last year, about this time in 2021, I published an article about all the stock market predictions that all the investment firms and individuals were making for 2022. Link in the pinned comments below. Before we get into my usual analysis of the stock market health during this last week, let's take a look at some of those predictions that were made in 2021 and see how they turned out. You know, predicting the stock market's a little bit like predicting the weather. At best, forecasts are only good for a few days out, and even then they're subject to change. So here's a table that I put together of a bunch of stock market predictions that were made at the end of 2021. And there are a bunch of investment banks here. Bank of America, Citigroup, Credit Suisse, and so on. JP Morgan, you know this list. And what you're looking at here is the market they were predicting. So most of them S&P 500. Wedbush decided to forecast the NASDAQ. And then here's the last price in 2021 for that index. Here was their 2022 end-of-year prediction, the predicted change in the indices, and then the current price as of this past Friday, December 2nd. So here's the actual changes from the end of 2021, and here's the difference between their predictions and the actual change. So you can see all of them were wrong. All of them are wrong, some more than others. So what are they predicting for 2023 now that they were wrong in their predictions for 2022? Well, it's interesting. So most of them predicted gains for 2022, and we actually had losses. So what are they predicting for 2023? Losses. You can see that here in this headline. So if you're wrong one year, let's try and pivot the other way and see if we might be right. So how do the markets look after this past week? Well, let's always start with some perspective. Here's how the markets did over the past 5 days last week. And you can see we had a big jump here in the markets when the Fed said they might moderate their interest rate increases. So this is starting to look a lot more like a healthy market. You can see that the NASDAQ, the blue line, went up the most. That's what you want to see. Small caps were second, S&P 500 third, and the Dow Jones Industrial Average fourth. This is a healthy stock market rally. And what if we throw Ark Innovation into the mix? Remember, Ark Innovation consists of innovative companies that are still building their businesses. They're much higher risk, and you can see that they outperformed everything by quite a lot. Ark Innovation was up 7.25% for the week, while even the NASDAQ was only up 2.7%, so a little bit more than half of Ark Innovation's gain. This is a healthy-looking rally so far. And what if we look over the past month? Well, over the past month, you can see Ark tried to rally back here. It fell back, and now it's shooting up again. So again, this is starting to look a little more healthy. I'd like to see Ark continue higher. I'd like to see the NASDAQ continue higher, but we'll see where this goes. And if we look back over the past 6 months, you can see since this bottom here that the Dow has led the way out, followed by small caps, followed by the S&P, followed by the NASDAQ, followed by Ark. So this so far has not been what I would call a healthy rally. It's been a very timid and tentative rally. And really, you need to look at things in the long term. As an investor, you have to take at least a 5-year view. So how have these indices and ETFs done over the past 5 years? Well, the S&P 500 is up 53.26% over that 5-year period. The Dow Jones Industrial Average up 41.51% over that 5 years. The NASDAQ 100 up almost 90%, 89.11%. The Russell 2000 up 24.2%. And after this rally this last week, Ark Innovation up only 3.86% over 5 years. So this might be actually a good time to be buying it. Let's put those numbers in perspective a little bit here. So I said the NASDAQ 100 was up 89.11% over the last 5 years. Well, if we annualize that rate of return, that's a 14% annual rate of return. Now that's after it's down 27% this year. So, if this continues to move up, this rate could go higher than 14%. S&P 500, that 53% translates to a 9% compound annual rate of return. The Dow, a 7% rate of return. Small caps, only a 4% rate of return. And then Ark Innovation, a paltry 1% rate of return per year. Does this mean Ark Innovation is a bad investment? No, I don't think so. It's got to come into its time. It got hit with increasing interest rates this year, which caused investors to pull money out of growth and therefore Ark Investment. Those companies that 5 years ago were selling for a little bit less than they are now, their revenues and earnings have grown phenomenally since then. And now there's a disconnect between the way the market is pricing Ark and the earnings and revenue underlying the ETF. This usually spells opportunity. How do our current market dynamics look? Well, for those of you who've seen these videos before, you understand what this bottom analysis is. We have a bottom forming indicator in orange, bottom confirmation indicator in blue, a confidence level in the dashed line, and then we're just using the ETF SPY for a reference here for the markets. Now, these measurements aren't taken from the S&P 500. They're taken from a lot of things around that. But let's take a look at what we've seen so far. So we had actually a second bottom forming indicator back here at the end of September, followed by a bottom confirmation here at the end of October. And why is this a bottom forming indication? Well, the orange line was at 100%. It doesn't even need to get there to have a bottom forming indication. And the confidence level was very high. I think it maxed out at about 98%, which is very good. Here we had the bottom confirmation indicator at 100%, and you can see the confidence level is also very high. So we had a bottom confirmation here. Now, the blue line again went to 100% here, but the confidence level was low. But now what's happening, the blue line is at 100%, and the confidence level is fairly high. So this might mean good things for next week, but we'll have to wait and see. What about equity versus safety? This gives you a sort of a shorter term look at the markets and how they're doing. And I think it's a good indication. So I always reference August 17th because the market was in a fairly healthy condition back then, believe it or not. You can see that the highest risk equities, IWM and the NASDAQ 100, small caps in the NASDAQ 100 were ranked 1 and 2, followed by S&P 500, followed by the Dow. What's wrong with this is we have an unhealthy treasury market here, where long treasuries are ranked 9 and 10, and shorter treasuries and cash are ranked higher. That's an unhealthy treasury market. And then on September 30th, we had an unhealthy stock market and an unhealthy treasury market. So cash was king. And then last Friday, on November 25th, now we have a healthy treasury market here, and equities are starting to come back up. This was starting to look good. Now, where does that leave us this past Friday on December 2nd? Well, we still have a healthy treasury market, and you'll see that when I show you the buying and selling pressure. But now the Qs, the NASDAQ 100, are the highest ranked equities, and hopefully these will continue floating up and displace the treasuries. And then we'll have a healthy stock market and a healthy treasury market. That will be very welcome after this past year. Let's take a look at the buying and selling pressure. So if you look further back here, the gray line is the buying pressure. The orange line is the selling pressure. Obviously, you want the gray line to be above the orange line. You want higher buying pressure, lower selling pressure. And you can see for most of this rally here, the buying pressure has been above the selling pressure. But more recently, it's come down. Now, how does that relate to the S&P, the NASDAQ, small caps, and ARK? Well, if they're doing better, the buying pressure should be higher here at the end, not lower. Well, the S&P kind of looks like the Dow a little bit. You can see the selling pressure really tanked here kind of at the end. But the NASDAQ 100, the buying pressure is still fairly high above the selling pressure. This looks good. The Russell 2000, buying pressure well above the selling pressure and the price increasing. This looks good. And Ark Innovation, buying pressure well above the selling pressure and the price moving higher. This is starting to look good. Okay, so let's take a look at the sector rankings and how the sectors are doing. And if you've seen my previous videos, these are not ranked 1, 2, 3, 4. There's 3 of each of these ETFs in the model. So XLE has 3 components, ITA has 3 components, XLB has 3 components, and so on. So these numbers are not going to go 1, 2, 3, 4. But you can see energy is still ranked number 1. Aerospace defense actually was down here last week. It's moved up into the number 2 spot. Materials are ranked number 3. This bothers me a little bit because increasing material costs are inflationary. I'd really like to see this go the other way. Industrials are doing well. And then financials are obviously doing well because interest rates are higher and financial companies benefit, banks benefit from higher interest rates. What bothers me about this table is that cash is still stubbornly in this table. I'd like to see it fall off the end. One of the things I'd like to point out about XLE, which is ranked number 1, is that yes, we've had a big price move up here, but you can see that it's faltering. It's starting to pull back. These best sector rankings have a fairly long time frame, so it's going to take a while for any of these to shift either up or down. In fact, you can see that XLE energy is ranked number 1. But if we look at the price of XLE over the past 6 months, you can see we've had a very nice rally here, but it's also coming down, but it's still ranked number 1. So as this pulls back, if it continues pulling back, XLE will eventually move lower in the rankings. So I wouldn't run out and buy XLE just because it's ranked number 1, because you can see the price movement doesn't look good here. What about the worst sector rankings, the bottom of the barrel? Well, obviously, Bitcoin and Ark are right here at the bottom, followed by biotech, consumer discretionary, telecom, real estate, and so on. Now, just a few weeks ago, 20-year treasuries were ranked down here really close to the bottom, if not at the bottom. And you can see they've been steadily moving up to a better ranking. This is a good look for the treasury market. And since we're talking about treasuries, let's look at the buying and selling pressure. Now you can see back here that the intermediate treasuries had a huge spike in buying pressure back in early November, which then sort of fell off but is now coming up again. And you can see the price movement has been going up very nicely here. But what's happening as you go out longer? Well, if we go to longer duration, you can see now this is flipped. So these are 7 to 10 year duration treasuries, which I kind of refer to as intermediate to long treasuries. And you can see, yeah, when intermediate treasuries had a huge spike here, this one had a little spike, but now this one has a huge spike. So bond investors are starting to take more risk and go out longer in duration. This is a good sign for the treasury markets. And what about the long bonds, 20-year treasuries? Well, you can see a similar thing here. We had a pretty good spike back here, which pulled back, but now the buying pressure is going up again as the price increases. This looks very, very healthy. What about gold? Gold's a tough one. Gold is hard to make money with. It's very fickle. It goes up based on news, based on what the other markets are doing, and it's correlated to absolutely nothing. So what we have here is we had a very nice start to the rally here as the markets were anticipating that the Fed would start moderating their interest rate increases because that makes the dollar drop and that makes gold go up. Well, that kind of faltered here. And you can see that the buying pressure peaked out here and then really fell as gold prices kind of went down, and now it's sort of trying to rally again. I don't have a lot of faith in this, and I wouldn't be a gold investor under most circumstances. Now, what about cryptos and the crypto market? I mean, you've all heard by now the whole mess with FTX and the potential fraud there and huge losses of crypto assets. And you can see what happened to the price of GBTC, which invests in Bitcoin. You can see it just tanked here, and it's been going kind of sideways to down until this fallout and this contagion is well past us and the markets have more confidence. This may go sideways for quite a while. It's really a shame because crypto as a technology is a fabulous technology. I still very firmly believe in it, but we have to get past these bad actors that are causing the markets to not do well. So where does this leave us? Like I said earlier, predicting stock markets and stock movements is like predicting the weather. Your forecast is only good for a few days at best. But I have to tell you, based on the indicators that I look at, the markets are starting to look more healthy. That doesn't mean they'll continue going up necessarily, but I got to say right now, they look more healthy than they have in a long time. I'm Calvin Rose, and thank you for watching today. That's all for now.